Imagine waking up one morning and realizing that the world's most powerful financial institutions have been quietly preparing for something big, while most everyday investors were busy watching stock prices move up and down. Behind closed doors, central banks are buying gold at the fastest pace in modern history, and almost nobody is talking about why this matters to you, your savings, and your future. That's exactly what we break down here on Metal Market Insight. If you want to understand what smart money sees before the headlines catch up, this is one of those stories that only makes sense once you see the full picture. It begins with a simple but uncomfortable question. Why would central banks, the very institutions that issue paper money, be rushing to buy an asset that pays no interest, produces no cash flow, and hasn't fundamentally changed in thousands of years? What makes this trend even more interesting is who is doing the buying. Countries like China, Russia, India, Turkey, and other BRICS and emerging market nations are adding gold month after month at record levels. These are not small or symbolic purchases either. They are massive accumulations that are actively reshaping global reserve balances. This isn't emotional buying or short-term speculation. It's calculated long-term positioning by institutions that operate on decades, not quarters. When China buys gold, it isn't trying to flip it for profit. It's quietly reducing its dependence on the US dollar. When BRICS nations increase gold reserves, they are signaling a desire for a financial system that doesn't rely entirely on Western currencies. And when emerging markets buy gold, they are protecting themselves from currency shocks, sanctions, inflation spikes, and debt crises that can wipe out national wealth almost overnight. This is where the conversation starts to make a lot of people uncomfortable, because central banks don't buy gold when they are confident in fiat currencies. They buy it when trust is quietly eroding, when money can be created faster than real value, when debt levels become politically impossible to repay, and when financial systems rely more on confidence than on solid fundamentals. In the United States, many still believe the dollar is untouchable, and to be clear, it remains the world's reserve currency. But reserve status does not mean risk-free. It means responsibility. That responsibility includes funding massive government spending, managing rising interest costs, and carrying ever-growing deficits. Central banks around the world are watching this closely, because history shows that every major fiat currency eventually gets tested. Not through sudden collapse, but slowly through inflation, loss of purchasing power, and policy choices that favor debt over savers. This is also where most retail investors misunderstand what's really happening, because central banks are not day traders. They don't care if gold moves up or down this quarter, and they aren't reacting to headlines or social media noise. They buy when gold is boring, when sentiment is mixed, and when mainstream attention is elsewhere, and then they hold for decades, sometimes for generations. Retail investors, on the other hand, often chase price, hype, and fear, buying late and selling early when volatility hits. That difference in time horizon changes everything. When central banks accumulate gold, they're not betting on short-term price action. They're betting on relevance, on gold remaining a neutral asset in a world where currencies are increasingly used as political and strategic tools. So the real takeaway here isn't about predicting chaos or betting everything on one asset. It's about mindset. Central banks buy gold not because they expect the system to collapse tomorrow, but because they expect uncertainty to exist forever. They understand that the world is moving into a future shaped by rising debt, digital currencies, geopolitical tension, and shifting economic power, and gold remains one of the few assets that sits outside all of that. The question for you isn't whether gold will shine tomorrow or next month, but whether you'll recognize the signal before it becomes obvious to everyone else. Are central banks being overly cautious, or do they see cracks forming that most people are still ignoring? Drop your thoughts in the comments, share this with someone who still believes gold is a relic of the past, and stay with us here on Metal Market Insight, because the oldest asset in the world might quietly be becoming the most relevant insight.